Wall Street analysts are quietly studying the Pi model. Banks are looking at decentralized mobile mining frameworks. Institutional research teams are analyzing networks with massive user bases that do not follow traditional crypto patterns. And when you look at the data they are examining, something wild happens. The GCV theory suddenly does not look crazy anymore. It starts to look strategic. Today, we are breaking down exactly why major institutions may be getting ready to move on Pi network, and what that could mean for every single pioneer holding Pi at this very moment. Before we dive deep, make sure you subscribe and tap the notification bell so you never miss the latest Pi updates. Drop a comment saying, "Pi network to the moon," along with your country and flag, and let us fill the comments with pioneer pride and show the world how powerful and united this community really is. Now, let me be crystal clear. I am not here to promise you a specific price. I am not saying Pi will hit any particular number. What I am going to show you is why some of the smartest financial minds on the planet are starting to pay attention to what we have been quietly building, and why that should matter to you. For the first time ever, Pi network is starting to show up in institutional research reports. These are not public hype articles. These are private internal documents that major investment firms use to evaluate early-stage opportunities. 3 specific factors are catching their attention. First, user volume equals economic power. Pi has over 35 million engaged users who have passed KYC. That is not just a vanity metric. That is 35 million potential economic participants. Most countries do not have that many people actively using their digital payment systems. Pi is effectively a ready-made digital economy sitting on a blockchain. Second, compliance equals institutional comfort. Many people complained about KYC, but that requirement is exactly what makes institutions take Pi seriously. Banks cannot touch projects where anonymous wallets move billions with no verification. A network where participants are verified is an entirely different conversation. That is something compliance departments can actually work with. Third, regulatory alignment equals global legitimacy. The Pi core team has been preparing for MiCA compliance in Europe, the same regulatory framework that most crypto projects are scrambling to understand. Pi is not scrambling, it has been building toward this from the beginning. When a project shows regulatory readiness before regulations even fully hit, institutional investors notice. Here is where it gets really interesting. Institutions do not look at Pi the same way they look at Bitcoin or Ethereum. When a firm like Goldman Sachs analyzes Bitcoin, they see digital gold, a store of value and a hedge against inflation. When they study Ethereum, they see a smart contract platform and a technology play. But when analysts look at Pi, they see something fundamentally different, a future economy. A closed-loop economic system with built-in demand, verified participants, and real-world utility being developed from day one. Bitcoin has value because people agree it is valuable and it is scarce. Ethereum has value because developers build on it and it powers decentralized applications. Pi is being designed to have value because millions of people will actually need it to participate in a functioning economy. That is a completely different value proposition, and it makes traditional finance very curious. Now, you might be thinking, if this is real, why do we not see big public announcements yet? Because institutional investment almost never starts in public. When major firms identify a potential opportunity, they do not go on television and talk about it. They quietly research it. They send analysts to study the technology. They set up private calls with the team. They watch the community's engagement. They build models under different market scenarios. They do this for months or even years. We saw this with Bitcoin from 2015 to 2017. We saw it with Ethereum between 2016 and 2020. By the time mainstream media started shouting about institutional adoption, the smart money had already built their positions. So the fact that Pi is now appearing in internal research is a very important early signal. Let us look at 4 concrete signals that line up with previous institutional adoption cycles. Signal 1. Pi is building a self-contained economy. Banks love closed-loop high-activity networks. Credit card companies do not get rich because dollars are special. They get rich because trillions in transactions flow through their networks. Pi is building a marketplace, apps, merchant systems, and peer-to-peer transactions. This is not just a token, it is the backbone for a new transaction network. That is exactly what financial institutions understand. Signal 2. Pi has massive merchant adoption potential that is already emerging. Even before Open Mainnet, thousands of merchants around the world accept Pi for real goods and services. Hair salons in Vietnam, restaurants in Nigeria, shops in the Philippines, tech services in India. This is happening organically, before official merchant tools are fully rolled out. Once those tools launch at scale, transaction volume can explode. Signal 3. Pi is perfectly designed for digital-first and underbanked regions. Across Africa, Southeast Asia, South America, and parts of Eastern Europe, millions of people have smartphones but weak access to traditional banking. Pi's mobile mining model lets them join a digital economy without expensive hardware or large capital. That is financial inclusion at scale, and it is exactly where the next billion crypto users will come from. Signal 4. Institutions love assets that move across borders without friction. International transfers are slow, expensive, and messy. Blockchain assets move globally in minutes with minimal fees. Pi is being designed as a global medium of exchange from the ground up. No single country controls it, no central bank dictates supply, and no government can easily freeze cross-border usage. That kind of borderless efficiency is extremely attractive for global businesses and investors. Put those 4 signals together, and the foundation for institutional interest is not just present, it is robust. Now we get to the part that connects directly with the GCV conversation. Most retail investors assume institutions want the price as low as possible so they can buy cheap. But that is not how settlement assets are viewed. There are 3 major reasons institutions actually prefer high-value units. Reason 1. High value reduces transaction volume for the same economic activity. If Pi is worth $1 and a business needs to move $1 million per day, they must move 1 million Pi. That creates heavy blockchain load and potential congestion. If Pi is worth $100,000 and they still need to move $1 million, they only move 10 Pi. Fewer transactions, less congestion, faster settlement. For large-scale finance, that efficiency is golden. Reason 2. High value simplifies merchant pricing and accounting. Businesses hate dealing with long decimals and tiny fractions. A high-value asset lets prices be expressed in simple fractions, like 0.1 or 0.01 Pi, rather than endless decimal places. That improves user experience and makes accounting cleaner. Reason 3. Pi's design mirrors how reserve assets function. Gold and, increasingly, Bitcoin are valuable because they are scarce, globally recognized, and used as reserves. Pi has a fixed max supply, a global distribution base, verified users, and an economy being built on top. Reserve assets do not become valuable because they are cheap, they become valuable because they are scarce and necessary. When you understand these reasons, the idea of a very high-value Pi token stops sounding absurd and starts sounding structurally possible, if Pi fulfills its full vision. Again, this is not a promise. It is an explanation of the logic institutions use. So what does all this mean for you, the person who has been tapping the mining button for months or years? In past cycles, when institutions began accumulating Bitcoin, early holders saw life-changing gains. When Ethereum gained institutional attention, many early miners became financially independent. The pattern is simple. Early participants who understand the vision and stay through the building phase are the ones positioned to benefit when institutional capital arrives. Pi could follow a similar pattern, but with even more distributed ownership and a larger verified user base. Pi has focused on real-world utility before open mainnet, not after. Its compliance-first approach reduces barriers that Bitcoin and Ethereum had to fight through. If institutional flows come into Pi in a similar way, pioneers holding Pi today are not just early, they're sitting in one of the most interesting digital asset positions of this decade. Now we need to be honest. Everything we have discussed, research, signals, logic, depends on one critical milestone: the full transition to open mainnet with complete regulatory finalization. Right now, Pi is still in the enclosed network phase. Pioneers can use Pi inside the ecosystem, but major exchanges cannot list it, institutions cannot buy it directly, and the broader market cannot freely trade it. This is by design. The core team has prioritized infrastructure, KYC, and compliance before opening the floodgates. Until open mainnet launches with clear regulatory green lights, institutional investors are mostly in research and prepare mode. They can study. They can model. But they cannot deploy at scale. The true market value of Pi will only be discovered once open trading begins with full liquidity and global access. So what does this mean for you in practical terms? The window of opportunity is this enclosed network phase. Right now, you can accumulate Pi through mining with no institutional competition and no capital outlay. You can complete your KYC, migrate to mainnet, and participate in the emerging ecosystem. This window will not last forever. Your edge right now is time and access. If you believe in Pi's vision, stay consistent with mining. Complete your KYC if you have not. Use Pi in the ecosystem where you can. Support apps and merchants. Every real transaction contributes to the on-chain demand story that institutions will eventually measure. We are possibly watching something historic develop in real time. A mobile-mined cryptocurrency with tens of millions of verified users, building real economic infrastructure, pursuing regulatory compliance, and drawing quiet institutional interest. Whether Pi reaches the full GCV prediction, half of it, or even a fraction, the pioneers accumulating now and holding through the transition to open mainnet are placing themselves inside a very rare opportunity. If you found value in this breakdown, make sure you are subscribed. We are going to keep tracking every signal, every regulatory move, and every hint that institutional adoption is getting closer. The next months are going to be critical for Pi Network, and you do not want to miss what comes next. Thank you for watching, pioneers. Stay focused, stay patient, and keep building.